Kia ora, I'm Mary Jo, Kiwi Bank economist. So we end this massive month of May with a big bang. The Reserve Bank's latest monetary policy statement was certainly more hawkish than many of us, and indeed financial markets, were expecting. And to be quite frank, the Reserve Bank would have been hard-pressed to deliver a dovish statement. It's hard to argue against the recent run of strong economic data that we've seen come through over the past few quarters. Now, the Reserve Bank's new forecasts were little changed from their last set of forecasts in February, which were relatively upbeat. One minor tweak is that they're now expecting another quarter of negative economic growth, which means another technical recession. But we're not too concerned. We've closed our borders to international visitors, and at a time when foreign spend is typically at its peak. So a slowdown in economic activity over the summer period is to be expected. But March quarter aside, the New Zealand economy is ultimately on the road to recovery. The Reserve Bank's new forecast also suggests that we might be past the peak in the unemployment rate. There's still considerable slack in the labour market, but it's so far shown and proven to be remarkably resilient. And a tightening labour market does place upward pressure on wage growth and therefore inflation overall. Now, our economic recovery from the COVID shock definitely stands out on the global stage, but that also means that our central bank sticks out, particularly their stance on future monetary policy. From the Reserve Bank's perspective, they're much closer to achieving their dual mandate of a full employment and a target 2% inflation rate than many other central banks, and indeed far sooner than many of us thought would be possible. So in terms of the Reserve Bank's next steps, they brought back the OCR track in their latest statement, as we had hoped. And from it, it suggests that we may have seen the bottom in interest rates, including mortgage rates. According to their outlook, the next move in rates is higher. The Reserve Bank has signalled 2 potential 25 basis point rate hikes next year. Off this, we've pulled forward our call and now expect the first hike to be delivered next May. And it doesn't stop there. By 2024, the OCR track suggests a cash rate close to the neutral cash rate of 2%, which is when monetary policy is neither stimulatory nor contractionary. Now, it's important to note that not to mistake the OCR track for forward guidance, given that it is conditional on several assumptions. But nonetheless, the trajectory in rates from here is clear. No matter how you look at it, downside risks are receding and upside risks are rising. So the pathway toward a normalization of monetary policy has been laid out by the Reserve Bank. That's it from me this week. I'll talk to you in the next one.